what you're going to see over the next handful of months, especially over the next year, in terms of monetary metal upside is going to be awesome and far different from the tone we've seen over the last 10 years in gold, for example. They push the throttle, especially gold, and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow, not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it, and they sold it, and thought, oh, this is the top, this is the top. It wasn't at the top. It was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from
Michael Oliver, who is well known for his proficiency in momentum and structural analysis, has been receiving a lot of attention lately because of his audacious predictions for precious metals. The current state of the market, according to his study, is paving the way for a significant revaluation of both gold and silver. Oliver contends that as economic instability increases, we are witnessing a much deeper structural shift in how investors, institutions, and even governments regard real assets, rather than just another round of short-term price swings. Oliver believes that knowing the breaking point of trust in fiat currencies and central bank policies is more important than merely establishing price targets. According to him, gold is at the core of this change. As confidence in the dollar continues to decline, its continuous progress through important technical hurdles portends something much more than just speculation, a global shift toward safety. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets. We'd love to hear your predictions. Drop a comment below.
Because, this has been going on for a while now, okay? I understand from various bank reports that I've read or heard about of analyzing their customers that are invested in the market and have an account in the bank that does that. The use of leverage has never been higher than it is now, and yet it's persisting. Okay, so you can make an error, but keep making it, and the longer you make it, the worse the consequence, probably. But again, the issue is when. Okay. Yeah, it's a reality. Those are objective facts. But again, when? And that's what we're focused on. And I do think it's a key factor right now, because when it does crack, we know what's going to happen to the central bank. They're going to go berserk, even more so than they already are. Which case they'll lower rates, but they'll also increase money supply, et cetera, et cetera. But and that will impact other markets as well, because when they push the throttle, especially gold and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow, not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400. And it went dead sideways for 5 full months. They sold it, and they sold it, and thought, oh, this is the top, this is the top. It wasn't at the top. It was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid-30s, lower 33, 34 area for a year. In fact, in last May of 2024, it was up to 32.70. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sep, boom, silver goes from mid-30s to what? 43. Okay? So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm going to move some money over there. But when they do, it's wet bar of soap time. Squirt on the upside, because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it, just an assumption. Right now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and it'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. You went from 2000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market, and go back 50 years when the government approved it for us to trade, God bless them. You've had two bull markets. There were eightfold moves from bear low to bull high, different duration of time. One was from 76 low to 1980. The other was from 2001 low to 2011. But they were both eightfold multiple gains for gold. We bottomed at 1,045 in December 2015. If we get eightfold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even fourfold yet. Okay. So that's something to consider. I don't trade off of it. Maybe we're not going to go eightfold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced, especially when you look at gold miners. Gold miners, we don't have any charts on this, but relative to gold, the valuation of, for example, the XAU index, which has been around since the 1980s. The 1980s, 90s, and into 2000, like up until about 2007 or 8, it was trading at either side of about 25% of the price of gold. In other words, divide XAU price into gold, it was about 25% of the price of an ounce of gold. It would oscillate above and below there. In fact, the low end of that multi-decade range was about 17.5%. So let's remember that. In fact, when you see the spread chart, if you have one, we publish it routinely. Let's call that resistance now. In other words, if you ever get back up there, you bump your head on it. Okay, where is gold right now? It's like pushing up toward, it's 7.6, 7.7%, I think, right now, XAU divided into an ounce of gold. So you could double and a half the miners right now on a relative price basis just to get to the underside of the prior multi-decade valuation that they used to have.
Michael Oliver emphasizes that the impact would surpass charts and price milestones if gold rose to $8,000 and silver pushed past $50. According to Oliver, this change may set off a potent feedback cycle. Demand for tangible assets like gold and silver will increase as confidence in paper money declines. Prices rise as a result of this demand, which further demonstrates the declining confidence in fiat money. Oliver presents this as more than just conjecture, which is what makes his argument so strong. He contends that it is a structural requirement. The financial system is experiencing irreversible fissures due to massive debt loads, constant money printing, and changing geopolitical dynamics. Show some love by hitting the like button, subscribing to the channel, and turning on notifications. Your support means a lot.
First of all, how undervalued silver is in relation to gold and where you think silver might be going.
Well, if you look at that chart, what it shows is pick the monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16 Okay. We're very suppressed, very depressed relative to that norm. Okay. And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%. And back in the 1980, got up to 6% plus. Okay. So just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at, but when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay. So it's catching up. But there's a breakout level on that spread that says, I'm going to launch. And we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level. Probably even further, but let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold went dead sideways at 4,000, let's say, and silver went to 2%, you do the math, okay, $80. If silver goes to its norm, gold goes to its normal 8-fold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high. GDX, XAU. Gold's way above its 2011 high. And even a bloody base metal, copper, is currently trading above its 2011 price high. Is silver going to stay a dog forever, or is it a mistake? And you and I know, being in markets long enough, you'll find markets that get excessively overdone on the upside and are making a mistake, and other markets that get excessively cheap relative to other assets on the downside, and are ignored until finally they wake up and you say, golly gee, I wish I'd realized that. Whoosh. And silver, our argument is, the technicals argue to us, silver between now and the end of the year, in all likelihood, is going to gush past 50 and be in somewhere in the 60-70 range. And that's not the top. I'm just saying as the first gush. Ultimately, we're going up to that 2% level.
According to Michael Oliver's research, silver might reach $80 an ounce, which would be over twice its current value, assuming gold remained unchanged at $4,000. Furthermore, silver's 2% ratio would cause its price to approach $160 per ounce if gold rose to $8,000, which Oliver thinks is very feasible. Crucially, this is a recurrent trend in market history rather than mere conjecture. Silver doesn't simply climb when the ratio breaks out because gold falls, rather it rises more quickly than gold, and the two metals usually move vertically higher together. Additionally, he highlights how silver is falling behind other assets. Even mining indexes have risen, copper has topped its prior peak, and gold has already broken well above its 2011 highs. Oliver contends that silver's continued stagnation below its previous highs is an error that will eventually be corrected by the market, and that the correction will probably be abrupt and severe. According to him, silver may see its first gush before the year is over, rising beyond $50 and into the $60 to $70 region, with much more growth to come. Oliver cautions that a significant collapse of the US currency is imminent. Price charts may still appear solid, but momentum research, which is his area of expertise, reveals that the dollar's strength is eroding. Global markets will be rocked if the dollar drops into the 70s on the index or even hits new long-term lows. That breakdown would be like rocket fuel for precious metals. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really